Good morning. Everyone hear me in the back? All right, great. First of all, I'd like to thank you for the opportunity to speak in front of you and thank some of the SAIA board members that I bothered incessantly until they gave me a chance to speak to you this morning. Like Daryl, I am also from Wisconsin. Unlike Daryl, I don't have any crafty slides having fun with Wisconsin, so I'll just piggyback off of his. My name is Tim Oleszczuk. I'm a managing director and co-founder of TKO Miller. TKO Miller specializes in helping founder and family-held businesses, and with a special focus in industrial services businesses and specifically scaffolding transactions. Today, what I'm going to talk to you about is helping business owners maximize the value when it comes time to sell their business and avoid some common mistakes that they make, which ends up leaving millions of dollars on the table and sometimes even worse, millions of dollars in the pockets of their strategic buyers. It's a sad thing that we see time and time again when scaffolding owners and operators spend their entire careers building value in their business only to leave that value on the table for not running a good process. So today we're going to talk broadly about maximizing the value of your business in a sale. That's going to apply to many businesses. We're then going to look at some scaffolding specific issues in some of the things that we've learned over the years. In order to give you a full feel for what a scaffolding transaction looks like and how you can maximize value, we're going to flip it around and give you a thought as to what buyers are thinking about when buying a scaffolding business. And finally, we're going to talk about some recent M&A news, and to Daryl's point, yes, we're going to talk about Brand-Safway. I've spent a good deal of time writing on the subject. We're going to get into it. I think everyone I talked to last night when they found out I was speaking today couldn't wait to ask if I was going to talk more about Brand-Safway. So, hello and welcome, or as they say in Montreal, bonjour and bienvenue. No matter how much I practice that, I sound like an American guy trying to say French words. So last night at dinner, one of the guys I was out with said, when you walk up to someone in Montreal, they immediately size you up and determine whether you're a French speaker or an American. And obviously no one that I met in Montreal yet thought that I was a French speaker because they went right to English. So I'm very excited to be here. I've spent nearly my entire career in working on scaffolding transactions and have really worked with and against nearly every major scaffolding company in the industry. And I've worked in all aspects of the industry, from manufacturers to virtual manufacturers, manufacturing overseas and importing, to small mom and pop scaffolders, to all of the big boys. It started back in 1994 when I helped Figge International sell Safeway the first time to a couple of German companies. I stuck around and I did Safeway's acquisition work. We tried to sell Safeway again in 2002, and what we ended up doing there was educating the private equity market. We're going to talk a little bit more about that, and it really helped shape the future of scaffolding M&A. As private equity got in and bigger dollars came in, the transactions continued to grow. All the way through doing 17 acquisitions for Safeway. I helped a private equity group buy Brand. I dabbled in it and helped them buy Aluma. So I've been in the industry for a long time. Again, nearly 25 years, 25 plus transactions, $2.5 billion in scaffolding alone. And I probably should have figured this out at a very young age, that I was destined to be in the scaffolding industry working on M&A transactions. Because when you're in second grade and the teacher had the little boys and girls stand up in front of the class and say what they wanted to be when they grew up, all my fellow classmates on the boys' side said, doctor, lawyer, football player, or fireman. And I stood up in front of the class and said, I want to be the king of scaffolding transactions. I was surprised they didn't give me a special test to try and kick me out of class, but they let me slide through. So today I'm going to talk to you very generally about running a process I'm not as good as Daryl as keeping up with my slides here, so I'll catch up. Running a process to maximize the value when it comes time to sell your business. You're going to hear me use process a lot. There is no such thing as one process. We're going to talk today about 6 broad factors that apply to many business sales, whether it's a scaffolding business or not. But really a process is defined by your advisor, whether it's your investment banker or another advisor, and it's typically based on either dozens or maybe up to 100 judgment calls to design that process for your specific company in order to help you maximize value. So we're going to talk about the 6 broad processes or the 6 broad pillars today, but again, don't think this is something we just roll out and apply like a robot to every transaction. The first step in any process in deciding what to do is define the objectives. And it sounds simple, and you may think, well, that's easy. It's, get the most cash or the most proceeds you can. And that's sort of a given, and that's not really what shapes the process. What shapes the process is, what else do you want to do? And that can range from, I want to keep the location open after I sell. I want some of my employees to continue to run the branch. I want to have a continuing role. Ultimately, a big question that we would ask you is, what do you want to do following the sale of your business? And it can either range from, I'd like to stick around for a short transition and then ride off into the sunset, or I'd like to partner with the next owner and be a big part of the company going forward. And if you look over on the right there, the answer to that question will generally decide what types of buyers you're going to go to. If you want to ride off into the sunset and take your money and not be a part of the business, financial buyers are not going to be interested, most likely, in buying your business. A financial buyer, just so we're all on the same terms, you'll hear me say either financial buyer or private equity buyer, but a financial buyer is a group that collects funds and is charged with investing those funds in businesses in order to create a financial return. And so a good example there would be Odyssey before they bought Safeway. They were a financial buyer. When they bought Safeway, if they bought your company, would obviously be a strategic buyer. Someone that's in the business, someone that's looking to roll more businesses into them, whether it's competitive businesses or they're looking to expand their product offering. Obviously, after Odyssey bought Safeway, there's a third term up there that we don't have, which is a quasi-strategic, which is a strategic buyer owned by a private equity buyer. And again, a lot of the bigger companies are owned by private equity these days. So once you understand the objectives, the next step is to develop and tell the story. And every business has a story. And the key here is to control the information and tell a thorough story. You want to tell everything that's good about your business. You want to paint the business in its most favorable light, but you also have to cover, some of the negatives of the business. And the reason I say that is because as you'll hear as the process rolls out, if you don't cover the negatives, a buyer these days is going to find out. The level of due diligence in transactions grows every year. There used to be 3 main areas of due diligence. Now there's about 15. Everybody's got an expert. They're looking at everything. They're going to learn the negative things about your business. It's better to get them out front and be able to control that message with that story. One big area where business owners make the biggest mistake in telling the story or presenting the story is anytime a buyer shows up at a scaffold company or any kind of business, the first thing they ask for is, why don't you send me over your financial statements? It's a huge mistake for a seller to make, just sending out your financial statements. And the reason is, financial statements may be great for running your business or reporting to your bank, but what they're not great for is telling the story of your business in a sale. And the reason I say that is, financial statements don't account for, personal expenses you run through the business. They don't account for one-time events. They don't account for excessive compensation. So what an investment banker does when preparing the financial statements as a big part of the story, because it's ultimately going to play a big role in your valuation, is we come through and we normalize and we adjust the financial statements. And again, we're going to talk about some specific areas when we get to CAPEX in a little bit. But this is why I say most business owners, when you ask them what their cash flow or their EBITDA is, they can look at their financial statements and give you a number. What they can't do and what they don't do very well is tell you the cash flow or EBITDA they should use when selling their business. So once you've done that, you've got the objectives, you've got the story down, identify the best buyers. And again, this will be dictated a little bit by what your plans are following a transaction. Do you want to partner with a private equity group? More private equity groups are getting into this business. Or do you want to stick around for some transition period and then ride off into the sunset? Be very clear, regardless of what you decide, regardless of who your buyer is, that buyer is going to want you to stick around for some transition period. Most scaffolding transactions, if you break it down and the talent walks out the room, you're buying a bunch of equipment, any buyer is going to want to make sure that they're capturing the value in that business, usually in those relationships and that method of running that business that owner or that key manager has done. So they're going to want you to stick around for some transition. When it comes to buyers, critical element here is you've got to cast the net wide enough to make sure you catch the outlier. If there's 5 buyers out there, I don't really care if 4 of them are going to pay the same price. What I want to do is cast that net and define that buyer universe to catch that outlier that's going to pay you the higher price and allow you to achieve some of your other objectives. Once you do this, the next thing is you want to disseminate that information to the buyers. Obviously, under a CA, you get the buyer signed up under a confidentiality agreement. You start sending out the information. A critical element here is your credibility. I can't tell you the number of companies that we've looked at that have had 5 years of flat performance, and all of a sudden, starting the year after they sell the business, they're going to grow by 20% and all their margins are going to improve. Obviously, you guys have seen that. We call that the hockey stick. And the minute you send a document out there with a hockey stick, you're going to lose all credibility. And it's not just in the financial side. There are going to be other issues that come up in every transaction that you're going to need to deal with. You need to maintain that credibility. Something else I've got up there is share information in layers. While I just told you you've got to be thorough in the story, when it comes to the most sensitive information of the business, you have to hold that back and share that when you get down to the last couple of potential buyers. That may be your price list, that may be your customer list, that may be how you do business, it may be your comp structure for your salespeople. It could be any one of a number of items, but it's your secret sauce, and you only want to be disclosing that late in the process as you move and buyers get more serious. All of these things we're doing, now I'm going to find the back button, Daryl. All of these things we're doing is to create competition. And what's kind of ironic is scaffolding business owners and scaffolding companies obviously see competition every day. Most of the bids or the projects you're bidding on are a competitive process. That's done to keep your pricing, for the customer to try and keep your pricing down. In fact, we see even most scaffolding owners using competition to their advantage. I've seen scaffolding owners get 5 bids to buy toilet paper for the shop floor. And yet, when it comes time to sell their business, they forget all that, and one buyer shows up and they talk to one buyer. And the reason I know that is, for 17 acquisitions for Safeway, I was that one buyer. And I knew they weren't talking to anybody else. And I knew they were going to leave money on the table. And so it's an important thing to remember. You do this to create competition, to get multiple buyers and then there are multiple bidders to allow you to push value. All of this is done to finally create leverage. You want to have alternatives when you get to the end of the process. You want that final buyer that you select to know that you've got alternatives and that if they don't behave as they go through the final 60 or 90 days of due diligence, that you have the ability to go back to another buyer. So all of these are important. And again, these apply primarily to really any transaction, whether it's in the scaffolding space or a different business. And now what I'd like to talk to you about is some specific issues that we see all the time in scaffolding transactions that affect valuation. I want to talk a little bit about valuation. Scaffolding business, like many businesses, are typically purchased or valued on some multiple of cash flow or EBITDA. It's funny that a lot of people, maybe some in this room, think that in order to do my job, you probably could have learned those skills back in second grade, back to second grade for a minute, when you learned how to multiply. Because a lot of people think what investment bankers do or other advisors in our space is they find out the EBITDA of the business, they multiply by 4, 5, or 6, and voila, you've got a transaction. It's a lot more complicated than that, and frankly, just understanding the multiple. I give another speech called More Than Just Multiples, where we actually look at 40 to 50 different factors that can affect a multiple when buying a business. One that's always there is growth. You're going to hear me talk about growth throughout today. Business owners need to show growth. If you can show growth to a buyer, you can command a higher multiple. And that's true whether you've got a small mom and pop or whether you've got the new Brand-Safway. You've got to show growth to continue to drive value. One of the places where a lot of sellers will make a mistake is they'll look at their buyer and they'll look at what that buyer's going to do with the business. And what they try to do is they try to capture that value for what the buyer is bringing to the table. And certainly it's a fight that we fight on behalf of sellers, but it's a very difficult fight to win, and again, hard to get paid for what they're bringing to the table. But I want to give you an example about, people think this is just multiplication and valuation is just multiples. But as I said before, most business owners don't know their true sales side cash flow or sales side EBITDA. So in our example, let's say that they think the number is 3 and I think that number is $4 million. And if they think that business trades for anywhere between 4 and 6 times, if you just do simple multiplication on the low end and the high end, 3 times 4 is $12 million and 4 times 6 is $24 million. You're sitting there with a range of $12 to $24 million for a very nice scaffolding business. You add to the fact that a lot of times businesses trade for below those multiples or above, and you've got business owners making decisions on value that they've tried to build their entire careers based on what we call country club lore. Those businesses trade for 5. Those businesses trade for 6. Anytime you talk to an investment banker or someone in the business and they say that trades for 5, he has no credibility. He has no idea what your business is like. He has no idea about the intangibles. He's selling you a bill of goods. In order to figure out what the multiple is that your business should trade for, he's got to get in there and ask you, 15 to 20 questions at a minimum. So be careful for that. So a couple of areas that we're going to touch on specifically in scaffolding transactions: capital expenditures, the treatment of those and how they impact cash flow. Geography, where you're located. It's not a lot you can do about it, but you should understand it as to how it's going to influence demand and influence pricing. Management and key personnel. We're going to get into that as to how you may need to stick around in order to maximize value. End markets and customers. Again, who are you selling to? What kind of scaffolding business do you have? Recurring revenue, backlog. What I'm trying to do there is just what kind of visibility do you have into the future performance of your business? And we'll talk more about that in a second. And then to a lesser extent, inventory management and equipment condition. We'll touch on that. There are a number of others I could have added on here. I could have talked about your rent to re-rent and how that might affect your business and your valuation, your safety, your bonding, your union versus non-union. But again, I want to touch on a couple that we see over and over in scaffolding transactions, so we can touch on that. So the most obvious one that we see a lot is the treatment of capital expenditures. And when looking at valuing a scaffolding business, a buyer will often look at your CAPEX and may try to take that off of your cash flow when determining your valuation. A lot of times that's driven by whether they determine it to be maintenance CAPEX. In other words, do you need to spend that CAPEX just to maintain the trajectory of your company or the performance of your company, or is it growth oriented? And what's funny is sellers realize this very quickly, and they send you information. They'll say everything's growth oriented. And you look at their performance, you say, well, your growth CAPEX hasn't done much because you haven't grown during the time you've been spending growth CAPEX. So it's something that you can't just call it growth CAPEX and so be it. You need to have the backup information. But the classic push and pull here with CAPEX is the scaffolding owner's constant desire to minimize taxes. And so when they buy a piece of equipment and they're looking at how do I minimize taxes, the obvious answer is you expense it. And that pulls your taxes down. But the challenge is it also pulls your EBITDA or your cash flow down. And so one of the biggest changes that we make in financial statements when we go out to the market is we look at how they've treated their CAPEX. We bought a rather large company for Safeway, and their EBITDA was 30% less than what we recast it at. They left more than $15 million on the table in that transaction. So a very important mistake here, one you should be thinking about. The other thing that's unique in this industry is we've seen a number of unique ways to fund your CAPEX. Some people, for example, in the hoisting space may get their clients to pay for CAPEX in larger projects. Some groups out there may sell used equipment at very profitable rates and use that to refresh their fleet. So those are important things if you're doing those to share with your advisor so that he can adequately portray them and make sure you're not leaving dollars on the table. Geography, again, not something that you can outwardly control. You're located where you're located. But what you should know is that it's an important part in determining your value and making sure that you're going to the right buyers that are going to value where you're at. There may be a number of buyers that are looking to round out a geography and get into your location. You want to make sure that you're talking to those. Management and key personnel. As I mentioned, when a buyer buys a scaffolding business, they're not just buying a bunch of scaffolding assets most times. They're buying the relationships, the customers, the processes, the way you've run that business. And a critical element in maintaining that value is figuring out some way to make sure and make that buyer comfortable that you're going to adequately transition those relationships and those intangible values to that buyer. Because I'll guarantee you, in nearly every transaction, if that buyer, if that owner walked shortly after the closing or a key salesperson walked, they certainly wouldn't be getting the value of that business. Non-competes or earnouts, where they may structure how much you actually pay for the business based on the performance following a transaction. Again, if you're trying to stretch value, that may be appropriate. A lot of times when we're representing sellers, we try to avoid that. And depending on, again, the structure of the transaction, maybe they'll invite that owner to reinvest back in the business if it's with a private equity group or they want you to stick around for the transaction. End markets and customers. This gets into the sort of the dichotomy between being a commercial scaffolder and an industrial scaffolder. Commercial scaffolding, obviously, you've got the project-based, fixed price, greater return, greater reward. Comparing and contrast that to the industrial side, many repeat customers, some under contracts, some long-term contracts, but you're working under a time and materials type basis. I talked to a couple of commercial scaffolders, and they see what's going on with the Brand-Safway merger. They think there's going to be a lot of opportunity in industrial. I agree with that. And they're talking about getting into industrial scaffolding potentially. It's tough to get into on a small basis. A lot of those are bigger projects. And again, it can be a very different business profit-wise from what you're used to, on the fixed price commercial side. But it does provide more stability. Anytime you can portray to a buyer, more predictability about future cash flows, you're going to be better off. We're going to talk here. One of the biggest knocks as we get into recurring revenue, one of the biggest knocks and challenges in selling a commercial scaffolding business is buyers view it as project nature. And so they think, every year or every turnover, we've got to go back and generate more customers. Even when we tried to sell Safeway in 2002, when they had $300 million of revenue and had grown for the last 9 years, we still had buyers say, yeah, but what about next year? And so, people eventually got comfortable with it, but you can imagine even on a smaller scale, that's a challenge. So anytime in your revenue you can paint a stream of predictability and forward-looking, sorry, I'm hitting buttons. You can predict a stream of predictability, you're going to be better off. And lastly, down at the bottom there, and this is a minor one, we see it in some smaller transactions, but it's also a problem that we see consistently in nearly every scaffolding business. Inventory management and equipment condition. I will ask scaffolding owners, how much equipment do you have? And they'll stand up and they'll say, we trust our inventory system religiously. And I'll say, well, great, when's the last time you did a full inventory? You can't really do that. I said, what do you mean you can't really do that? And they said, well, stuff's all over, it's not serialized. And again, not to beat the Safeway drum, but Safeway does an annual inventory every year. And so to say that you can't do it, it's just not true. It becomes important sometimes in smaller transactions when the amount of inventory and the quality is driving the valuation. But there's a group that we've seen, Avantis, that's got a booth in there, help you with your inventory management. At any point in a transaction where when you can portray sophistication and that you're on top of things, it's going to give that buyer more comfort in paying that price. Any indecision costs you dollars, any comfort gains you dollars. And so, to the extent, you can, have a sound inventory system, again, it's going to pay off for you in the long run. Again, we could have talked about a couple others. I'll be sticking around if you want to talk about re-rent and bonding and how some of these other things affect valuation. But what I wanted to do real briefly before I get into the M&A update is talk about the flip side of a transaction. And you're going to hear a lot of opposites here, so I'm not going to spend a ton of time. But, having spent a lot of my career on the buy side as well, I wanted to tell you what it's like, standing on the buy side, not just the sell side, which we talked about. And so when you look at why a lot of larger consolidators or larger strategic buyers go through acquisitions, here are just a couple, and we'll talk a little bit more about each of them. But expanding geographic footprint. Scaffolding is an asset that's difficult to move. It's costly to the extent you can fill in branches. Between existing branches, you can increase your efficiency, you can increase your utilization. If you're in one of those locations, you may be more valuable to certain buyers. Eliminate a competitor. Certainly if there's a competitor in your region that's giving you problems, sometimes it's better to just buy them. They may be doing things you don't like, pricing or other ways of competing. Sometimes you want to just go out and purchase them. You want to be very careful when you're doing that to make sure that non-compete and those restrictive covenants keeping that person or that group out of the business are in fact enforceable and very strong. We probably all know of a couple companies in town that sold their business and showed up across the street, sometimes literally across the street, and back in business. That buyer certainly didn't get what he would bargain for. Sometimes they grow, will buy a business to grow their fleet. Again, these would be smaller transactions. A number of times, though, when we were looking at some larger equipment purchases for Safeway, we said, gee, we're going to spend $3 or $4 million on equipment. There's a nice branch. Maybe we're stretching a little bit on price to buy that, but we're going to get the $3 or $4 million worth of equipment, and we're going to pick up some good ownership and some good customers as well, so maybe it's worth structuring it that way. Again, typically smaller transactions, and that's one where you really want to know what equipment you have there in order to capture that value. Growing your financial profile. We talked about this before. You're going to hear it again when I talk about the Brand-Safway merger. Showing growth is critical to building the value of your business. When you get to a certain size like the Brands or the Brocks or the Safeways, oftentimes within a market you've got such a large market share, it's difficult to get beyond a 25 or a 30%. And a lot of times what happens is people are just trading customers and there's not a lot of organic growth. And so as you've seen over the past years, probably Safeway most actively in the last 3 or 4 years, is people out there working on transactions in order to show the growth. And that feeds into the next point where we talk about capturing value. As you're a bigger company, you trade at higher multiples. We talked about multiples before. You trade at higher multiples. So a smaller business may trade at 4, 5, or 6. The Safeway transaction just traded at probably about 9.5 times cash flow. Again, that sales cash flow. And so a lot of times, these companies, the larger companies, can go out at 5 and turn around and be valued at 9 or 10 times and pick up a tremendous arbitrage there. So that's a real benefit for them. On top of that, when they buy someone generally within their industry or within their space, they're often taking out some costs and maybe adding some revenue in there. And so it's really a double whammy and a very positive for the buyer there. So just quickly again, just looking from both the buy and sell side, maybe stating the obvious here, but a buyer's objective, buy at the lowest valuation. I would also say you don't want to buy so low where, if that seller finds out that he's upset and doesn't want to stick around and help you out. But buy at the lowest valuations on the best terms. Make sure you structure that transaction in order to ensure you're getting what you think you're getting. And when you look down at the bottom and you compare and contrast those two, they're really opposite. When you're a seller, you want to maximize the number of buyers. You want multiple competing bids. You want to control your process, and you want to sell on your strengths. And certainly when you're a buyer, it's just the opposite. There's a term in our industry when you're a buyer and you deal with one seller, and it's called a proprietary deal. And there are private equity groups that make their living off of proprietary deals just because you buy so much better. In nearly every transaction we did for Safeway, we were the only group dealing with them as a buyer. And as a result, we avoided that competitive process and we did very well. So again, just thinking about it from a different perspective. Recent scaffolding news, I think Daryl last night when I talked to him called it the elephant in the room. Obviously it's the Brand-Safway merger. For those of you who don't follow me on LinkedIn, I think I wrote 4 articles on this already. I've got a couple more coming out. I've been writing about it since March when they announced it. It was completed in June. And what I want to talk to you about, it's going to have a profound effect on the scaffolding industry for the next 5, 10, 15 years. You've taken the 2 and maybe you can say the 3 biggest behemoths in the industry, you've put them together. It's going to have ripple effects throughout the industry. What I want to touch on before I talk about those effects is I want to tell you why I think it happened. So back in 2013, Brand was being sold by its then owner, First Reserve, and was going to be put together with Harsco's infrastructure division. And Harsco's infrastructure division, it had challenges for many years. We always used to see the annual restatement of the performance of the Harsco infrastructure division. It was only a matter of time before that was sold, and they got that out of there. In fact, we met with the interim CEO and told him how to sell it, and he took it down the street and had his buddy who was in investment banking turn around and sell it to CDR. CDR, for those of you who don't know, is Clayton, Dubilier, and Rice. I'm going to call them CDR. They're the group that bought Brand and Harsco. And when they bought Brand and Harsco, they were promised a lot of synergies and a lot of things that would, a lot of costs they would pick up through putting these 2 behemoths together. And I think one of the things that prompted CDR to go ahead and pick up Safeway as well is that integration was not going well. And I think that CDR lost faith in some of the senior management at Brand to in fact capture some of those synergies. And what they decided to do is they had a pretty big bet already in buying Brand and Harsco, and they decided to double down. Partly because they're a private equity group, they're looking at exiting that business anywhere from 4 to 7 years. You're already at 4 years. And so when they don't see a path towards exit, when you get to year 4, they start to get very nervous. the owners of Brock have hunkered down and have not done anything over their 4 to 7 year period. CD&R tried to go the other route and double down in order to buy Safeway. I think they're betting on Safeway, maybe the senior management team, but what I really think they're betting on is the process system that Safeway operates its business under. Safeway is a heavily dominated, process-oriented, decentralized business, very different from Brand, which is a centralized, run it out of the headquarters, very little tracking, again, relative to Safeway. I'm sure they've got a lot of tracking, very little tracking out at the branch level. And so it's going to be a real mix of two companies putting these together, and there are going to be some real challenges. One of the articles I wrote was, Brand-Safway, an integration nightmare. And I heard from one of the senior members of the Safeway team that they're very excited that I wrote that article, because when they do it successfully, they want to have a burning party and burn that article. So I think in a subsequent article I tried to, it was a very inside joke, but I said the Safeway management team has a burning desire to do this very well. So we'll see how that turns out. It's going to be a real challenge. You've got the attitude of, Brand used to think you can't make money in commercial scaffolding. Safeway grew up as a commercial scaffolder and only got into industrial scaffolding in the 90s. Very different mindsets. Fixed price, time and materials, putting these together will be a real challenge. One of the important issues that I think will have an effect on all business owners and people in the market is whether Brand-Safway, I got to get used to saying it, whether Brand-Safway will continue to be a buyer for smaller scaffolding or scaffolding-related companies. In their past, they would pick up the $5 or $10 million scaffolding company to round out a market or to fill a geography. But now when you're a company that's $5+ billion, you can't waste, my thought is you can't waste your time doing $5 and $10 million transactions, even ones that make tremendous sense. So I think when you're a scaffolding owner, it was nice to always have Safeway in your back pocket, that no matter what, we can show it to Safeway and they'll at least likely take a look. So someone else is going to have to play that role, and without a national commercial scaffolder out there, it falls off pretty quickly as you're getting to the regionals, and the amount of funding they have, may make it difficult to get transactions done. One of the things I think you're going to see on the M&A side, I think M&A is going to be critical for Brand-Safway. I think they're going to need to go through M&A to generate growth. I think ultimately they're not going to see revenue synergies. I think they're going to see revenue decline, because I think when a lot of their industrial customers where you see the greatest overlap, I think a lot of those customers may have been getting a couple of bids. Maybe it was Brand and Safeway and Brock, and now you've only got 2 of those bidders at the table. And I don't think they're happy about that. I know there was some concern about getting through Hart-Scott-Rodino antitrust approval, but they're not going to be happy with that, and they're going to invite new providers in. So that's going to be an opportunity for the next layer of industrial scaffolders. Whether that's Brock or whether that's Petrochem or Brace or Empire or Solid Platforms, or whoever can step up in some of these areas of heavy overlap, I think is going to have a real opportunity here. Secondly, with all the combination, there's not a lot of overlap in the commercial side. I know Brand picks them up with the patent acquisition through the Harsco deal. There's not a lot of overlap there. I don't think there's going to be a lot of consolidating people out of a job on the commercial side. At least, in my mind, if they do it right, they'll leave commercial alone. But on the industrial side, again, I'm sure they promised CDR, we're going to consolidate a lot of these branches, we're going to consolidate operations, we don't need 3 sales guys, we don't, all of this. It's going to lead to a lot of very talented and well-seasoned industrial scaffolding professionals out in the marketplace. And if it's the one thing I've learned in this industry, is scaffolding people never go away. They just morph into something else. whether it's starting a new business or a new company, or they show somewhere, or they get a truck and all of a sudden they're back in business. They don't go away. It's what they know. They're good at it. They get back into that business. So these people aren't going to go away. So I think there's going to be an opportunity there, for some real growth there. The next thing I think Brand-Safway, has already started the process of thinking about going public. Frankly, they have to do that fairly soon, because pretty soon the market might figure out that this isn't going to work so well. There's a lot of high hopes here, and putting three giants together is a very difficult task. A lot of times it's easier to sell blue sky to the market than it is true results. So, look for them to be going public. That's going to provide that liquidity that CDR is looking for. It's also going to provide capital for additional acquisitions. I think you see up there, my hunch is that when I look at large transactions that are available in the scaffolding and multi-craft areas, I think a lot of them have already been purchased. I think Brand-Safway to make a dent is going to have to do big deals, $300, $400, $500 million deals. Not a ton of those left in the scaffolding and multi-craft space. I look for them to expand. To me, a natural expansion is the forming and shoring market. It's a tough. I've always thought it's a tough place to run profitable operations, but there are certainly some companies available there where they can make a $400 or $500 million acquisition. And again, with Wall Street awash with cash, that money is going to be available for some of these transactions. So, just want to make sure I covered all of those. Oh, I was a little surprised. I guess they didn't read my articles too carefully, because I said leave commercial alone, run that out of Waukesha, Wisconsin, and then figure out industrial. At least from their press releases and from talking to some people in the industry, they obviously came out with this union, non-union structure. And I think, frankly, that's probably one of the only ways if they're true to that they can screw up the commercial side of the business. If you've got union reporting up one channel and non-union reporting up another channel, their strength has always been their ability to work together, share equipment, and move that equipment where it can best be utilized. So it'll be interesting to see how that really plays out, and whether that's just to allow them to pursue a double-breasted strategy, which Brand always kind of got and Safeway never got comfortable with. So again, that was a little surprising they decided to organize it that way. So how will the merger affect you if you're a commercial scaffolding provider? Maybe not a lot. Maybe not a lot. If they're smart, they're not going to do a lot with the commercial side. If they're not smart, they might try this union, non-union thing, and if that screws up the efficiency of the operation, that may be a challenge. If you're at all in the industrial space or thinking about getting into it, I think there's going to be tremendous upheaval in that space. I think, again, there are going to be people on the street. Market share, I think, is going to be available. I don't think all of the customers are overly excited about having one less group to deal with. And I think there are going to be a lot of acquisitions, again, in and around that space. So to close, I just want to give you a real high-level overview of just the general market, M&A market in general. It's really hot right now. And I thought it was going to end 2 years ago, and it continues on. And if people are thinking about selling their business, I think they're looking at the next 18 months or potentially the next, when the next down cycle comes back, if they want to maintain value. Cash is at an all-time high, both in the private equity side and now with Brand-Safway going public and opening up the public markets. I think cash is going to be extremely available in the strategic side. Brock just recently restructured its debt. I think they're still struggling. They say they're a buyer. I'm not sure that they are. But again, it's kind of a perfect storm. Lots of cash on the equity side, lots of debt on the debt side. Not a lot of sellers. Sellers are starting to come to the market, and when they are, they're tending to do very well. So with that, if you want to follow me, I'm here, And to Paula's side, I want to do something a little goofy, so bear with me. I want to take a selfie since I'm trying to be more like my kids and I want you guys to be in it. So, hope it worked. So, if you want to, if I didn't cover a topic you want, or if there's any time for questions, I don't know where I am with time, but be happy to stick around in the cafe for as long as you guys want to talk scaffolding. You won't bother me. I would love to hear some about your stories. With that, thank you very much.